Hello, this is Martin from seekedge. Welcome to the trading channel for investing and learning. So today we have a new series, trading psychology series, right? So we are talking about trading biases. What are the different cognitive biases that trading involves, right? Some of which we already know, but we're just trying to see and analyze them, and then you know uh, just for being aware about them. We're going through that. So it may sound a bit boring for some of you, right? But please keep. You will by the end of this video, will understand the importance of this bias, right? Uh, the importance of the trader psychology is much more than the importance of the strategy and risk management sometimes, right? uh, Even if you have a very good strategy and you have a very good execution of that and very well uh, position sizing and risk management is there in place, even then if your psychological biases are not handled properly, or if they are not worked upon, you could end up in still making losses. That is only the reason by very few percentage of people makes it big in the trading. This is one of the most critical factors to that. So let's just casually analyze and then look at some of these things, most of which we already know. We're just dissecting and then trying to classify it, and giving some labels, just for understanding purpose. That's all. So there is no need of by hearting the name of that, or keep remembering that, or all that. Such of the purpose. The purpose is to be aware that there are these are things that happens in the back of your mind, right? And these are very important, crucial, you know, elements that that if you improve upon can help you a lot. So what is a bias basically? Bias is nothing but an inclination or a preference, right? Um, a set of inclinations or preferences, you can say. So that can influence a lot on your judgment or decision making. So when you say decision making, that's very crucial for trading, right? Every minute, every day, every hour, depending on what time frames, what kind of whether you're a trader or investor, depending on that, you may be making decisions randomly, hundreds of decisions, whether to go long, whether to exit, whether so there's random decision making that happens. So a lot of external things, that some of which we are aware, some of them we are very conscious. Some of this we're not even aware. Subconsciously uh, we have a bias, right? They influence our thinking, our so when you say cognitive, it means anything that the bias is often known as cognitive bias, right? It's because it's to do with thinking and reasoning, right? Anything to do with that, right? So there's numerous decision making that happens, and these are all influenced by these biases if you look at. So basically some of examples, I'll just walk you through. uh, these are all scenarios that we face. Every one of the trader who is active in the market has faced it, uh, face it every day, or has faced it multiple times during their trading career or trading journey, right? So I'm just walking you through that. How many times have we must have invested in some stock for a short term, and then we turn out to be long-term investors because we didn't exit on time, right? How many times we do the hope trades, hope that this will work, right? And instead of getting out early, we don't do that. We don't exit on time, and then we are in the hope that the price may keep on reverting, right? We have all done this in a trading and investing, right? uh, we have been influenced by trading decisions numerous times, when we have the TV on, right? We hear some analyst saying something, or some channel news talking about some breaking things, some biased information, and we get biased, and our trading rules are broken, right? So another example is that we follow influencers in social media, right? We in different YouTube channels, so we follow them, and then we blindly believe them without without backtesting or without understanding the essence of the concept, and then blindly following, thinking that uh, even when our beliefs say that it is not true, we tend to follow them. So this happens to everyone, right? Now, how many times have we avoided buying? When there is a dip, we know that there is a time to buy, so that the market, when the market moves, we can gain. But we just can't do that. Because our bias says that it will keep on further falling down. But we just can't buy when it has already crashed substantially. Right? How many of us bought or invested in good stocks when it dipped in the COVID crisis of when it bit to 7,500 index? Now it is 16,000. 7,500 dip was an opportunity for everyone, but most of us could not do it just because we have the bias that it will further fall down to 6,000, right? So some stocks are very favorite for us. That's another example. We like this stock, right? This is a good stock. This can never fall beyond that, right? So our bias in our mind which is saying that, right? Um, yeah, so sometimes we have overconfidence on certain aspects, and then we tend to not see the other aspects which are even more critical, and we hold on to our, elements that we learned, right? Only the information that is given to, we see only good information, and we don't see anything wrong with that, even though it is there in the data. We don't analyze, and we tend to overlook at this. So yeah, so very normal example for a trader is like, how much difficult it is to hold on a profit. We tend to come out at very small profits every time we see the stock moving up. Our entry is correct, but exit is wrong, right? How many times we decide not to wait for the confirmation and we jump in, we jump the gun and we get in early, and then we fall prey to the traps. These are all things that happen because of only our mindset. Our rules, our strategy, everything works, but our mindset tells you something else because of the biases. That's what we are going to see. So this is actually a diagram that is published by a company that is written there in the bottom screen, the counter. So their website has it, the visualcapitalist.com site also has it. So this is the infographic which summarizes all the different biases. Basically, just walking through this is enough. Although I have some more slides there, but just if you can Google and then find this slide and then go through this. No need to study the name and label of that. That is not as important. What is important is, you know, to be aware that such a thing influences subconsciously or consciously. It influences us in our decisions, everyday decisions. So once that awareness is there, we would are less tended to fall prey to such biases, right? Not 100%, but the more we are aware about that, the more chances that we would come out of it and then save our money, right? Let's just quickly go through few of these, quickly. So some of this, we'll be seeing later in the slide also. Like you can see the gambler's fallacy, right? Gambler's fallacy, just to brief, some of us thinks that this has fallen down this much, now it cannot further go down. Next time it's going to reverse back for sure. But based on what? It just gives you a gut feel that that's what gambler's fallacy is. Okay. Next one, if you see hyperbolic discounting is what? You will just somehow want to get come out of it and at a very small profit. And when we do that, when we are profit booking early, when we are not supposed to, when we are supposed to trail, we just want small profit and get done with that. That is what hyperbolic discounting. Validity, illusion of validity. What is that? Like, just because it worked there in currency, it will work on this Infosys stock also. It's not necessary. But you just coming to the conclusion that because your indicators and plans worked there, it is likely to work here. Another one, ostrich effect. Ostrich effect is like hiding negative things. You tend to hide and then just try to come out of that. Just like an ostrich puts it and in the mud, in the sand, right? That is another bias. Post purchase oscillations. So once you have bought a stock, you'll find all good things about that, nothing negative. You'll unnecessarily find everything good early, right? And tend to not see the bad things, and then keep on holding them just to justify your rationalization of the buying, right? That is another bias. Reactive revaluation, devaluation, right? Yeah, so jumping into conclusions, right, about others, right, other stock competitors are not doing well because their products are cheap. So jumping into devaluating other things, so most of these biases are connected also. Risk compensation, right? They tend to take more risk right, uh, when certain conditions, right, or safety feel is there at that time, they would do this. If it is not safe, then they'll do that, which can bombard. Some point in time it doesn't work, right? Sometimes because we have that bias, we tend to that. I took more risk because I found that this condition was satisfied. Status quo bias is again, I want to maintain the status quo. Stereotyping is like, you find that certain things are always, bad or good, or are always good. Certain preemptive, certain category, so like, reality stocks does not work. Banking is always good. Stereotyping the entire reality sector, right? You're losing the opportunity in doing that. Endowment effect is like, uh, it is like, it is also known as sunk cost fallacy. Endowment effect is like, you spend a lot of money. I just can't. It has to be good. I have already spent a lot of money on this. I can't just come out of it. I just have to keep on holding, till I ruin. That is endowment. Courtesy bias is blindly for social acceptance. You do something, right? Not what your belief says. Confirmation is like only, you will find only the good things, right? With a larger time frame, you'll miss. Or, everything you will try to confirm, right? With whatever beliefs you already have existing. That's confirmation. So clustering is like you have certain cluster of information and then you will hang on to it. But that cluster is only a small cluster, hundreds of other clusters are there in the overall data, historic data. We don't see that. Now, blind spot bias is always thinking that I don't have a bias, right? And you think that others are biased. Others in the sense other factors are biased. Belief bias. Yeah. So so your belief says something, and then but if somebody is arguing and making his point, then you forget your belief and then have bias towards his argument, right? Bandwagon effect is like it's kind of bias of following others, following. You already discussed that, following the in another influencer or guru or somebody, or trading tip or channel or whatever recommendations and all these things. Availability is like only on available data you will talk about. Yeah. Certain non-available data is there which you don't even look up. Sometimes more non-available data may be huge set of data, and you look at a small data which is easily available and then jump into conclusions. Anchoring effect is first information whatever you have, you continue to believe that that is correct. Right? You don't keep it looking at the historic data or the further data that comes after the first initial information. So we keep on anchored to the first. So there are all different biases that is mentioned there. You can look at the slide and learn of it. Just you have to be aware that this all happens in the back of your mind. So some of this I have just put in a slide. I'll just quickly go through that. So gambler's fallacy I already mentioned, right? So certain event is less likely or more likely to happen based on the outcome of the previous event, right? So so something happened previously does not mean that it will, again, random event is what happened. So you don't understand that random, right? Facts, so events do not change, the probability. This fallacy came into place because of an event that occurred in the casino in the US. It's also known as Monte Carlo's fallacy or something, right? So this was basically, if something kept on happening, so much number of times, you tend to think that, oh, now enough is enough. It might never happen now again. Next, now it will reverse. We have fallen down. So in this casino also there is a roulette game that happened, and it went on a black, you know black coin or something, uh, and that happened several times, 30-40 times, and then people started betting on the other color, which is red, thinking that now that it has happened so much that there is less likelihood that there's more likelihood it will happen in the red, not the black. But actually, people lost huge amount of money in that casino because it continued for a long time, right? Because every time it is probability is still the 50%, right? Every new event has got 50% probability, right? So as long as you keep on playing, you don't know when that will come. Every time it is 50%. When that 50% change, so the probability is misunderstood basically. So people tend to think like that very often. In trading also, we very often we tend to think about this thing, right? Confirmation bias is like to find, always we'll find only what information that we believe in, right? We will see for example, we will look at whatever is comfort in our comfort zone. We look at a trade in a lower time frame and then that is doing good, we will see only that. We will not look at the larger time frame and see that there is some divergence there or something. We tend to not look that because it confirms everything that confirms with your belief, everything that you are comfortable with, you tend to look at only that. Right? That helps you not get an overall picture and you will end up into taking bigger risk and bigger losses. Loss aversion is one bias where you tend to avoid the risk, right? Because pain of losing is more hard, right? So you tend to you tend not to understand that there is no pain, there is no gain, right? So you underestimate that and then you just try to avoid uh, you know, taking the pain of losing. So these are issues that people, you're not talking about rational risk take, like, right? So extreme cases only we're talking about. Some people never ever take risk, although the risk reward clearly indicates that the pressure of the gain is more because they just can't suffer the pain of losing, right, psychologically. This tend to influence a lot in making investments and things like that. Some cost fallacy we've already seen. It's like certain investments you've made lost of money and it has been performing bad, and then it takes difficulty for you to abandon that stock also. You hang on with that, you don't come out of it, right? And since it has you have spent so much on that, you continue to spend on that, right? So that will influence you not to come out of it. So it's dangerous and you'll end up into bigger losses. That's sunk cost fallacy is something that happens every single day of a trader, if he is not conquered it, right? Just being aware that when you are not coming out of a stock, where your quantity position and sizing has gone wrong and you have clearly got exit signal and not coming out, it's nothing but you just thinking that you have to recover a lot of your previous loss, so you have to hang on this to make it happen. But ultimately, what happens is you lose everything. Right? Sunk cost fallacy. In hindsight bias, right? You think overconfidence. You think that you know to predict everything, and then you end up in trouble, right? Because markets are random, and that behaves in a different way. Trying to fix the way a market functions, you end up in trouble, right? Familiarity bias. You tend to invest or trade in only those which you are very much aware of. You don't take, so you may say, for example, you may not invest in gold because you trade only equity, but you are losing the opportunity to diversify your risk, right? So status quo bias, you maintain the status quo, right? So you don't take any risk, as long as last year it was comfortable, you know at this level this position size is good for me, I'll continue to that, even though so you lose opportunities. You want to maintain the status quo and not avoid taking the risk, right? You lose opportunities, consequence of inaction, right? So what has worked always, you'll stick to that, and sometimes that suddenly does not work. You lose opportunities and you don't have any backup, right? Bandwagon based, it's like we have already seen that, following some other people, some beliefs, ignoring your fundamental belief and your abilities and your assumptions and your gut feels. You follow somebody else because the crowd is doing that, you do that. Self gratification is like thinking that everything is your strength and your success, with your skills and everything is on your this thing. You end up in trouble. You have to be open minded to keep learning, right? Recency is your more recent trades. You don't look at the historic data, basically. Okay? You look at the new information and you don't look back. Right? Right? If historical data is avoided, then you don't trade well. Anchoring is relying on too much of information. Okay? You'll end up in buying undervalued or selling overvalued kind of trades, because your first information, whatever pre-existing information is there, you'll only refer to that. You won't refer to the information that came in later, just because you are anchored with that bias. Heuristics, using mental shortcuts, right? Sometimes you do shortcuts to solve the problem, but that may not be optimal, right? On a long term, so that can give troubles. Framing is always storytelling, right? You listen to the story, but you don't look at the facts or data and take decisions. So story is good, nicely told in the channel or magazine, and you follow that, and you end up in trouble, right? But you look at the facts, right, and non-biased, and then only you will succeed, right? So why do we need to know this? I already mentioned that awareness of this cognitive biases, we stand a better chance, right? If you are aware that you are not exiting from this position, you are jumping the gun and entering early before confirmation, right? You are not training the stop losses, right? You are not following the position sizing and aggressively betting, right? uh, you are not sitting idle when you are not supposed to trade. So all of this is happening is because of this. Just if you reflect back and then be aware, you tend to not do it more often, at least. Right? So that's a better chance that you will become a better trader, right? Now the cognitive bias that I explained, I may be good in explaining to you, but I myself, I am in the struggle, or I am in the journey, I am in the daily fight with this cognitive biases also, just like anyone. Does not mean that I am a supreme person who have overcome all these biases, and then it does not mean that. So this slide is just to create awareness about the need for you to be aware about these biases. That's all. I hope it helps you at least to refer to a lot of books and information that's available in the net, and then that will give you a lot of good insights to calm yourself and then find ways how to tackle these biases, right? You'll have to, so writing down journals, trading journals, right, will help you to reflect back on these biases, whether they are existing or not. Sometimes you don't even know that this is a bias. You may think that it is not your problem. You're not making profit because of some other markets problem or some external no things, and it is not yours. You become aware of that. It is that this is all your problem only when you start writing trading journals. You look back and then you write down which all mistakes you did, which all things you could have done better. Then you get reflection that this was probably a bias, and you work on that. It is not a one time. Just because you know that this is a fallacy or this is a bias does not mean that you overcome that. It takes several years probably to fix something, several months, several days, depending on how you are. So first step would be to identify them in trading journal, and then reflecting on them, mapping them to a bias, and then knowing that yes, you are getting caught with this bias, and then find ways to you know to to be more aware about that, and then slow down, and then take small steps to come out of that, and slowly every bias can be conquered, right? Once you come out of that, you will start. So it's a journey, it's not a one day thing. It's a trading is a journey. Yeah. So I hope this helps you in your trading, in your tanks. Thank you, and I wish you a happy trading and happy learning.